So here we continue from the video number three. So in this video number 4, we will be continuing talking about the tools. And then also I'm going to give you a very brief and simple explanation as to how to find a profitable trade. So where we were last time, we were talking about the scanners. Scanners, I said these are the tools that helps us finding an interesting trade for the day. And scanners are wonderful. Most of them are paid. Even the free ones, they don't work that well. So the trade ID as an e-signal, I use them a lot. They are inbuilt into my trading platform, so really seamless. It's just one platform that gives me all this. What they do is they allow you to look for certain characteristics in the stock market, and they give you these companies that you, in most cases, that you've not heard of, and you take advantage of not the big name companies that sometimes move a little bit, but what we are trying to do in day trading, and it's different from rest of the other forms of trading or even the investment, is here we are looking for big winners and also want to stay clear of big losers for that particular day or that particular week or that particular weeks or months, whatever your trading time span is like. So this gives us immediately, whenever you're starting to do your preparation before the trading hour, before the market opens, you run these scanners and you figure out. So what I typically do, because the US market, the opening time gives me a lot of time to do my research from the previous day. It's a perfect place to be in, actually, in Japan. If you're in Japan, it gives you a lot of time to take a call, to revisit some of the convictions that you've created in the morning, and it allows you to check whether those convictions or whether those there are underlying catalysts that are actually showing those movements in indicators that you are relying on, right? So scanners allows you to give you real-time changes in those indicators that you have prescribed, right? So you can set up, you can customize your scanners, and these are platforms. Right now, we are just talking about the list of platforms that are there. Now, scanners, as I said, are paid. So one of the solution to that is to use what is called screeners, which is on the bottom of your screen. And screeners are similar to scanners. The only difference is screeners are one-time search thing. They're like Google search. Anytime you click for a certain indicator, it will show up, it'll give you a list of those companies, and it remains there. It's static. Scanners, on the other hand, are all the time scouring the internet. They are looking for all the new information, and they're changing constantly. So you run them in the background, or you can have it on one screen, and you see the changes happening. And that allows you to actually look at the anatomy of the market to understand what the demand and supply of those stocks look like, and a lot of background things. So I'm going to give you a lot of other indicators and a lot of other techniques that are used by pro, but this is the starting point for figuring out which is the most exciting stock. Screeners are static, but we can use it. So I'm going to show you actually in the demonstration in the next video that I'm going to upload today, hopefully. So the 5th video will be about running it in real time with one of these screeners and see what we get from there, right? So the difference must be clear. This is an important part of the day trading. So then the other element, trading on the news. I said it in the last video, we don't like to day trade on news. Still, news are important. And the reason being, news allow us to check the veracity of certain moves in certain indicators, because we want to pin down if there is some movement that we see in one of the indicators, we want to confirm that there is a catalyst underlying that is driving these indicators the way they are trending, right? So news actually it goes backward. We test our movements and news work as catalysts. So there are a lot of places where you can get these news. Venzinga Pro, it is a paid platform for news. But if you are using any online website for getting information about finance, including Yahoo Finance, you would see that Benzinga is the source for a lot of those news articles. So you can get free access to it. Another place which I used to like it, but I don't have time so much, is the Bloomberg Radio. It's a free radio service which constantly used to play in the background earlier, but I don't do it as much. And it gives you a lot of the new changes in the market. But Benzinga is probably the best, but you get them in any trading platform. So, or any news platform, you'll get the news by Benzinga. So things that you are interested in are volume spikes you want to look at. There are volumes that are changing suddenly. Volumes are the total block of stocks of a particular stock, the block of stocks that are bought and sold. And as volume spikes, that shows the interest in that stock. Very, very simple. Stock holds are the process by which if a stock goes above certain threshold or it drops below a certain threshold, then the stocks are, that particular stock is stopped by the exchange. There are rules, depending on which country we are talking about, there are rules. There are what is called circuit breaker. Anytime the stock crosses a limit on the higher side, or if it crosses a limit on the lower side, those circuit breakers come into play. Now, you don't see them on a regular basis because the big stocks don't really jump that much, because we are talking about 5 to 7%, depending on which country we are talking about, those circuit breakers. And Apple, even on a good day, doesn't jump more than 3%. It doesn't go down more than 1%. And there are reasons for that. There are psychological reasons. We'll talk about that at some point. Also, if there is a company A is trying to buy a company B, then those kind of mergers and acquisition news also drive stocks. So these are some of the, not all inclusive, but some of the important factors that we try to confirm looking at the news, right? But that news is the source for us to check the veracity of the movement. Please keep that in mind. We don't trade, we never trade news. That's the most important part, because keep that in mind. I said that in the last videos, the machines they've already exploited all the juice that the news provides, right? So you will always be too slow to react to news. So we don't go in that lane. We just use news as our confirmation board. It allows us to look at the price movements and all the other indicators that come out of that price movement. We confirm them using the news, right? And even if you want to trade a news, then there's a fine print at the bottom. You want to wait for it, right? You don't want to be impulsive. It's not, there is no fixed time. What I say, quiz takers impulse, it's basically, you have to answer this question within a couple of seconds. So you have to move fast. There's no such thing in the market. There is never, you should not have FOMO. FOMO is the worst thing to have as a day trader. Fear of missing out is not helpful at all. So if you think the market has moved a lot and you've not taken advantage of that, that's perfectly fine. There'll be a lot of those big hits that'll come in your life. So you don't want to really, feel bad about a lost opportunity. That's perfectly fine. Third thing, which is very important, I consider it really important, is to track social media. That's become really important. I've been doing it for the last 6-7 years, using really, really rudimentary means, very manual way of going through, scouring through, running scripts on social media, running scripts on some of the blogs, some of the sites where traders used to hang out. There were those exclusive sort of invite only places where the traders would be discussing, and sometimes you have to pay for that entry. All those services were there. One of the Facebook co-founders, he started a company after he was booted out from the franchise, and he was not given credit. He won some kind of compensation because in court it was proven that he was one of the co-founders. Probably that's all is covered in the movie. I've not seen the movie Social Network. And so he started actually a app that has actually lost its relevance, but that was a social media for traders. And that was an amazing platform. And there are so many other places that used to be like that. But what has happened recently is we've got a lot more transparency, especially from Reddit. We've seen last year, there are automated AI-driven apps that looks through all that data and gives you a very good analytical and insight and very clear indication as to which side this stock is going to go, where these retail investors are thinking about. So Reddit has Wall Street Bets, which became really popular late last year, and especially early part of this year, January, February, when some of these stocks, so-called meme stocks, they rip-roared, they moved up unexpectedly with no fundamental change in the company's business. There was this zealous sort of evangelical, if I can use that word here, evangelical move or push to save companies or to punish the Wall Street people who are considered greedy. So there was some kind of a righteous sort of streak among these retail investors, and they were all grouping together. They were going after certain stocks. So Reddit became a hot place. And who made money from all that? It was the institutional players, because they started to focus on these places. And I don't know how many retail investors made a lot of money, but that information, that discussion, that transparent discussion, which was happening for the first time in the history of financial markets, did prove profitable for some of the institutional big players. And I don't want to go to Wall Street Bets. I've been using it for last 6 years. 2015 is when I introduced it in my MBA course. And I asked my students to actually go through and become a member of Wall Street Bets a long time ago. And when this whole thing happened late last year, I was not using it for a couple of years. So I was completely left out, but then you jump back. You don't want to go through those boards, because it's painstaking. It is not a pleasant thing, because it's very unmoderated. So you've got content after content, which is completely nonsense, and you get one tip somewhere, but you do see the mode of the market. And that's what I used to draw it using Excel, very basic macros I had in the previous years. But now you've got softwares like Hypequity. Hypequity basically tracks every word that's been said on Reddit vis-a-vis stocks, and it gives you a good compilation. And what I found is it to be extremely profitable, but this is a paid service. So you can use it for some time. I mean, I don't know if they still have that, like a couple of weeks, you can use it, you can sample it, and then you have to be. And now I have been the good thing about Reddit crowd or so-called retail investors is they are unsure. So they like the confirmation bias. They like to throw ideas around. And sometimes you see some ideas gathering momentum. And once everybody's talking and in unison that this is a great company, we should go and we should support this company because Wall Street is against this company. What you see is action that comes out of that clarion call. It takes usually 3 or 4 days to actually result. So you have plenty of time to take a position in those. And I'm not saying you should subscribe to Hypequity, but this is a good place to get those. And there are I'm sure there are a lot more apps that are coming, and a lot of them are going to be free. Part of it is going to be free. So I think we are heading into a democratized sort of information sharing. If you know what you're looking for, you will be able to find it for more or less free. Now, Stock Tweets is like Twitter for stocks, and that's a great place again. And there are you get a lot of you can see the headwind and tailwinds faced by certain stocks. Reddit, I already said. Twitter is too messy. I've never used, actually, I don't use any social media for that matter. I am an observer and I've kind of exited from all that. I shouldn't be bragging about it. It's not a good thing, but it has, there's too much noise. So if you are into it, by all means, if you have that kind of span of interest, if you can spend time into those services, by all means you can do. But there are apps that are analyzing. Please be aware of them. And if you find something that allows you to look through these different stocks and their movement, you want to share that with your classmates right now. And I'm always looking for new information about, new analytical tools. Now, Signal AI is one of the services offered by a Norwegian company called Meltwater, which is in the information processing. They primarily targets Twitter. So Signal provides you also the chatter about a particular stock on Twitter, and they analyze across languages. It's an excellent platform, again, paid. So I would not recommend any of these, but this is a place where you can get sometimes really interesting tips, which your scanner would not show, right? Or screener would not show. So this is all about tools, basic tools. If you have any question, feel free to ask about it in the Ask Me a Question forum page. Feel free to do that. Now we move to the heart of this course. One of the hearts, I would say, because this course is not all about day trading, but I want to really finish the day trading part as quickly as possible so that we can you guys can start using those tools to do your game, to ramp up your game, and then we'll move to the investment part. So the big sunny gift from me is the idea of how to find a profitable trade, right? And the maxim that I've created is one stock is all you need, right? All you need is one stock, as the song goes, or one winning stock a day keeps the misery away. So how do we do it? Let's get into it. So each morning, and in case of people in Japan investing in US stocks, it's going to be finding right stocks each evening. It starts from the basic idea of what drives a price of a stock up. What is the key driver of stock prices? If you understand that, and it's simple, pure and simple. It's a demand supply match or mismatch. If there is too much demand, the price is going to be higher. We know supply remains fixed, right? In the stock market, the supply of stocks does not change by the day. Sometimes it changes because there is a buyback by the company. Company buys back its stocks, and then the number of total stocks outstanding, it decreases. Sometimes the company issues secondary offering. They issues fresh stock, which is what the Wall Street backed favorite GameStop has done recently. So but the process of changing the supply of stocks, it takes time. It doesn't happen instantaneously, which means the supply, we can consider supply to be fixed. Now, demand changes all the time, which means demand is the key driver of the stock price. If the demand goes up, the price goes up. If demand comes down, the price comes down. That's the simple equation. If you understand that, then you will know where the dynamic is coming from. And from this prism is what I want you to see. So the big winners typically, and this is what happens, they move 20 to 100% every day. I'm not kidding. Every day you will find these big winners, and they all have one characteristics, this demand supply imbalance. And I'm going to, so the scanners or screeners they allow us to find these big winners on a daily basis. Now, the thing you have to keep in mind, screeners will give you what is trending vis-a-vis some of the terms, some of the analytical positions that we are looking at, some of the variables that we are interested in. But keep in mind, maybe those variables have been there for last 20 hours. In that case, that information, if that information that comes from screeners is stale, then we can't use it. So that's one big caveat that you have to keep in mind. All right, so scanning 101, I would say a few indicators, but it should not be, it's not all inclusive. You have to keep in mind there are thousands and thousands of indicators that traders use on a daily basis. We are only going to sample some of those, some of the easier to understand, and some of the most informative indicators we will be using. So I'm going to, like I said, we want to ensure that there is high demand for that stock to go up. That's thumb rule number one. And thumb rule number two is going to be, we want to ensure that the supply is low, right? High demand, low supply, that's the relationship you want to discover. And the moment we see, and when we are saying high demand, that high demand on a particular day, not on a long period of time, but just on a particular day. That's all we need, right? So the high demand, the four ways that we can confirm, and these are not all inclusive, again, that disclaimer. So high relative volume. Now, relative volume is something that the traders, the professional and the institutional traders have been using for ages. So this is something extremely good to know. So relative volume, I'll explain what it is. Relative volume is the volume of, which means the chunk of demand for a particular stock that deviates from the volume for the day, that deviates from the average volume that that stock was known for, right? So for instance, last 1 month, if there is a demand for, let's say, 1,000 stocks each day, but today the demand for that company's stock has gone up to, the volume that's trading is about 2 times or 3 times, which means 3,000, 4,000 stocks that are traded. 1,000 is the average for last 1 month or last 2 weeks. And today it's 3,000 stocks that are it's trading with. That means it's 3 times so the relative volume is going to be 3 in that case, right? So higher the relative volume, the better chances of that stock to go up. It typically goes up, actually. But the point you have to keep in mind is you have to strike when the iron is hot. If the relative volume has remained high for a long period of time, which means it is under the scanner of many people, many people are keeping their focus on this particular stock. And if that is the case, even though it continues to look high relative volume, because I mean, we are talking about a day's volume vis-a-vis so the whole day, it may actually, this data may look high for 24 hours or more than that. And if it's a weekend, for 2-3 days, you will see it high relative volume, but that information is stale. It's already been taken, made use of. So trading on stale relative volume is not going to give us a profitable trade. That's one thing. The second is, all this movement there has to be a reason why there is high relative volume, which means there is more interest among investors in that particular stock on that particular day. So there should be a news, there should be an event that is precipitating, that is helping that relative volume to appear. So the second point is actually connected. The catalyst, you have to figure out what that catalyst is. And the third is, sometimes there is no catalyst, right? You may not find a catalyst. And in that case, we call it pure momentum driven demand, which means everybody is going after a stock. And after a point, it becomes a snowball, because you see this whole surge in interest in that stock, and then other people join in. And the best example is the meme stocks that came out of the Wall Street bets. Reddit forum. So what GameStop or AMC or any of those companies, they had no catalyst that they did. There was no announcement that came from the company. It was just a clarion call. It was just all the retail investors, the individual investors, they banded together and they said, we are going to save this company. That's it, right? Because we like this company, maybe we like what it stands for, and we also don't like that the mainstream Wall Street bets, mainstream Wall Street companies, they are betting against these companies by using what is called shorts, right? They are shorting these stocks. Shorting is selling a stock that you don't own. You borrow it and you sell it. You borrow and you sell it, hoping that stock to go down, and then you buy it once it goes down, and then you give it back to the place from where you borrowed it, right? So shorting is a way to make money when you know for sure the stock market is going to go down or a particular stock is going to go down, right? So there was this kind of zeal among these retail investors. So in that case, it'll be called pure momentum. And if there could be a price movement, there could be a high demand based purely on momentum. And you have to recognize that, right? And that happens with the momentum. You will see that with high loyalty stocks, what I call high loyalty stocks, stock like Tesla, where actually the information is less important. It's just the investors are so driven by the vision of the founder of that company. And so many times you will find there is nothing fundamentally, nothing changes fundamentally, but people get excited by a tweet or by something, right? Some kind of interaction with the company, and that becomes pure momentum too. Fourth point, which will ensure there's going to be high demand, is the stock has to be cheap. If there's a cheap stock, more people, especially we want to trade alongside other retail investor as a day trader. Remember, as a day trader, you don't want to fight with the institutional guy because they have deep pockets. They can move the price a lot more than you can. So you want to focus on the stocks that are not interesting for a institutional guy. And typically these are cheap stocks, because cheap stocks, one thing is clear, they jump a lot. So our basic desire to get 10%, 20%, 100% up, they get, there's higher chances of these cheap stocks, which are also called penny stocks. So under $10 is what I prefer. That's one thing. The other part is the low supply, right? Low float, which means there are not many stocks available in the market. So I have put the number of outstanding stock or the float to be less than 100 million. But this is, I'm much more comfortable also with companies that have 10 million, less than 10 million, or around 10 million total stocks in the market. Now, if you have these two things fulfilled, then you find a winner for the day. Now, I will be in the next video, as I said, I'm going to be giving you a demonstration, a live demonstration using some of the tools that we talked about, basic free tools. So we'll screen it, and then we'll look at places like Yahoo Finance for all these information, the indicators of demand and supply, and trying to figure out whether we have a winner in our hand, right? So the way this whole thing works, there are typical sectors that I've noticed over the years. When you're looking at relative volume, you would see a lot of it, the low supply part, it applies to companies in biotech, pharma, or technology sectors, right? These are the sectors that are considered to be hot. And typical news catalyst behind driving these stocks is some kind of approval by FDA, for instance, is a big deal. If they have a new product line and if they get success with some of the trials, clinical trials, that also shows up on the more demand for the day. So any of those announcements, you can check them back. Now, I said you are not trading the news, but you're trading the reaction of investors. So there's a distinction, right? You are not looking at that stock because there was a news. You're looking at the reaction of the investors. And after that, you're cross-checking why investors are going crazy after the stock. And you confirm that with one news. Same thing about the tech, right? Some kind of new innovation that the company comes out with, a small, tiny company, and you see the stock roaring. So all that is there. Screeners, in terms of screeners, what are the major points that we want to scan? Like I said, there could be thousands and thousands different indicators that you can focus on. The most popular ones that show up by default are top volume, top gainer, and there is something called halts. I'll explain these in the next video. I will revisit the relative volume. I've already told you the high of the day momentum scanners, gappers. I'll explain what they are. Gappers is right here in this chart. You can see. So when the stock closes at a certain price in the previous day, and the next day it opens at a different point, there is a gap. There is no continuity. That shows in the after hours, there was something that came, there was a news that has created after hour activity. Now, please remember, there are market hours where people like us can, the retail traders can trade, but the institutional traders, they can, they can continue to trade even when the markets are closed. What is called OTC, over-the-counter exchange, where the dealers and dealers, they talk with each other and they say, okay, we can sell. And they typically happens because there was a news announcement, and bigger news announcements typically happen. Most companies do that in the after hours. So when the markets are closed, that's when the big announcements usually come. So that is what reflects the gap. If a stock goes up, as you can see here, there is a high chance that it is, I mean, depends how, if that news is persisting. Now, what you have in this case, after the market opens, there is some sort of lower. Now, this chart is actually not reflective. If I have this chart for hourly basis, I think I need to update this chart. This is giving you a daily chart. So each candlestick here is representing 1 day, and that is not sufficient information. What we need is, hourly or sometimes even 10 minutes candlestick chart. Then what you will notice is next day it goes up and up. So this green, this dark blue candlestick, basically what it represents there was a consolidation. It went up further, right? So there was a gap, and that's all we need, right? We are only looking this 1 day, and it has actually gone up. This is what typically happens. If there's a gap that comes during the after hour, the market returns with a vengeance, and they take it even further. So gappers are this is one of the most commonly day traded. I won't say common. A lot of people go into nitty-gritties of strategy based on the technical analysis. And what I want to tell you, we will cover technical analysis in the investments part, but a lot of those technical tools, they are so widely used that they are rendered useless. What you see here, there is a lot of potential to use them. So top gainers, top losers, that's what the scanners or screeners, we can use it. I'm going to show you, I'm going to demonstrate how that can be done. So you will see with some of the tools that we discussed today. I'm going to show that in the next video, and we will run that, and hopefully we'll have an evidence which says that we found a winner, right? Sometimes it may not, because I'm recording these early in the morning, and you don't have information, because a lot of information that comes and that goes in the market in the after hours, it gets revised. Sometimes those claims are disputed. So there is a FDA approval, but then FDA comes back with an additional note saying that this approval is conditional to these additional things that the companies will have to do. and all that tanks the stock. But before you go, not tanks, but you can be sure that even though that catalyst was there in the morning, I checked, by the time the evening comes, maybe there are some additional explanations which are making investors do double take. I'm going to also tell you when to. So we talked about the early hours are good to trade. I'm going to also tell you specifically when to trade. So one of these days, I will start trading in the night, and I'll try to record my screen, and we'll see how that works, right? So that is all for today. I'm going to see you in the next video. Till then, take care.